Hello and welcome to the channel. If you're new here, this is where we unpack elite wealth building strategies, tax optimization techniques, and investment frameworks guided by a chartered accountant's lens designed for high earners in the US, UK, and Europe. Let's talk about something most professionals get wrong. You work hard, earn well, and even save diligently, but your wealth doesn't seem to grow the way it should. Why? Because in 2025, saving alone is not enough. In fact, it can quietly hold you back. The truth is, you can't save your way to wealth anymore. Not when inflation, tax drag, and missed investment opportunities are compounding silently against you. Today, I'll walk you through how the wealthy approach investing very differently from the average high-income saver, and why that difference compounds into multi-million-dollar gaps over time. Let's begin with the mindset. Most people are conditioned to think of saving as safety. They build an emergency fund, park extra income in a savings account, and feel in control. But here's the math. In 2025, even a high-yield savings account gives you about 4 to 5% interest in the US. In the UK, you're lucky if it's 3%. In the EU, often lower. Now subtract inflation, still hovering between 2.8 to 3.5% depending on your region. Then factor in tax on your interest income. The result? Your real after-tax return on savings is often zero or negative. That's the hidden danger. You're playing defense with money when you should be playing offense. The wealthy, they treat liquidity as a tool, not a destination. Every dollar, pound, or euro must either compound, generate income, or protect other assets from tax. In the US, high-income professionals are setting up solo 401ks and backdoor Roth IRAs, allowing over $66,000 annually in tax-deferred or tax-free contributions. They're using real estate for bonus depreciation, tax loss harvesting through direct indexing, and even municipal bond ladders for tax-free interest income. They think in decades, not quarters. A real-life example, Jason, a surgeon in Florida, was earning $380K but losing over $100K annually to combined federal, state, and investment taxes. Today, through entity structuring, retirement account optimization, and a real estate syndication, he has legally reduced that tax burden by $34,000 while improving his portfolio yield. In the UK, the smart money flows through limited companies, ISAs, pensions, and advanced wrappers. Many combine salary dividend splits with full pension contributions to drive down personal tax rates. Some also invest in venture capital trusts and EIS vehicles for 30% tax relief and total CGT exemption after 3 years. Take Sophie's example, a digital consultant earning £190,000 in Bristol. She used to save £50,000 in a bank account. Now she pays herself £9,100 as salary, the rest in dividends. She maxes out her SIPP and ISA and uses carry-forward allowances to load £100K into her pension. By doing this, she cut her tax by over £27K last year while investing fully tax-sheltered. Across Europe, intelligent investors are using structures that often go unnoticed. In Germany, ETFs are held in tax-deferred wrappers, often accumulating funds that only trigger tax when sold. In France, Assurance Vie contracts allow investors to avoid capital gains tax for up to 8 years and even get partial exemption after that. In Italy, expats benefit from the flat tax of 100,000 euros on global income. And in the Netherlands, directors' pensions and tax-efficient corporate accounts are used for multi-asset investing under shielded conditions. But more than tools, it's about philosophy. The wealthy obsess over after-tax, inflation-adjusted returns, not raw yield. They measure efficiency per unit of risk and tax, not just market performance. They also track tax alpha, the amount of performance gained by managing tax drag strategically. So what does this look like in real life? Imagine Daniel and Olivia both earning £220,000 in the UK. Olivia earns everything through pay, invests in a personal account, and holds 30% of her savings in cash. Daniel uses a limited company, takes part of his earnings in dividends, maxes out his pension and ISA, and holds accumulating ETFs in a GIA. Over 10 years, Olivia accumulates around £400,000 after tax. Daniel over £680,000 from the same income, same market, same skill, different structure. Or take Leo in California versus Rachel in Texas. Leo invests $150K across mutual funds in a taxable account. Rachel uses Roth accounts, a solo 401k, and real estate for passive depreciation. Leo ends up paying taxes annually on income and capital gains. Rachel's portfolio grows undisturbed. By year 12, Rachel is up by over 20% more just from tax efficiency, and this difference becomes generational. Structured wealth is easier to protect, transfer, and compound. Now here's something practical. In tax advisory, we often run something called a capital exposure map. It's a breakdown of your assets by tax treatment: taxable, tax deferred, tax exempt. Try it for yourself. Tally up your investments, pensions, savings, and real estate. Ask, what percentage of this is growing tax-free? What portion is being eroded by taxes or inflation? If over 40% of your wealth is in taxable or low-yield assets, you're likely leaving six figures on the table over a decade. So, what should you do? First, restructure. Don't just save more, save smarter. Use tax shelters available in your region to the fullest. Second, shift your portfolio mix toward long-term tax-efficient assets. In the US, that means index funds, Roth accounts, and real estate. In the UK, ISAs, pensions, and VCTs. In Europe, look into tax-free bonds, structured insurance wrappers, and holding company portfolios. Third, focus on total efficiency. That means balancing risk, return, fees, and taxes, not just performance. And finally, take advantage of what most people ignore: time. The earlier you optimize your structure, the more power you give to compounding. Let me close with a final case. Anna, a dual citizen living between Portugal and London, built her investment base inside an NHR structure, shielding foreign dividends and gains for 10 years. Simultaneously, she built a family investment company in the UK to own a diversified portfolio. Every investment decision she made was filtered through tax jurisdiction, holding structure, and time horizon. The result? She now grows capital across borders, tax shielded on both ends. This is not about loopholes, this is about legally engineered wealth, built within the rules using the tools governments offer to those who plan. So ask yourself, are you building wealth or just collecting income? If you want more advanced frameworks like these, subscribe now and drop a comment with your country or region. We tailor our next breakdowns based on what you need, because in 2025, it's not the one who works hardest who wins, it's the one who structures smartest. See you in the next one.